What's up, team? Good afternoon to you. Got a lot of stuff to talk about today. We'll make it somewhat quick. I need to get like on Fiverr or something, have someone make me a theme song or something because, with copywriting and all that, it's really hard to play music. Although it does play music. Maybe I can do it, but they would probably just put ads. I don't put ads on my videos. So pending home sale number comes in, looking good. We're going to talk about that today. Very quiet day in the financial markets. Too quiet. I don't like it.
Yeah.
A lot of times quiet days like this are met with it's just sort of the calm before the storm. We could see a storm this week. So we're going to be on the lookout for that. Hopefully in the good direction. It could be in the good direction. Doesn't have to be bad. Remember that. As poised up as this all is for negativity to flow and knock the markets down further, it doesn't have to go that way. And it very well may not. Very well may not. We'll see. We'll take a look at that. One of the best cities in the world just recognized for my home state. We'll talk about that. 2 reasons why today's housing market doesn't look anything like 2008 from Keeping Current Matters. We'll take a look at that too. Maybe one thing on here that I'll show you that's kind of like, I don't like the way that looks. And then you're going to see a lot of people in the coming weeks and months talk about how, this market, even when I was interviewed on TV, she was like, I've heard that prices could drop 20 to 40%. Who's saying that? Who knows that? I mean, talk about guessing. I mean, and what area you're talking about, what neighborhood, because people don't live in San Diego. They live on 1, 2, 3, 4 Court, in that little pocket right there. So you think, this is the San Diego market. No, your market is your neighborhood. It's your immediate neighborhood, and particularly your type of home is also part of your market. So like we think we own homes in the San Diego market. You don't. You own a 4-bed, 2.5 bath in Rancho Bernardo, bruh. That's what you got. So, you have to look at, exactly what kind of your home type, your area, your neighborhood, your street. That's the market you're in. You're not in the county market. You're not in the city market. You're in the market of your home in your area market. So when people make these big predictions, maybe they'll be right on some market, maybe the worst case scenario, but they won't be right on the best case scenario. So I just want to show you what some people are saying because you're going to see more and more of this. There's too many people who make too much money off of the fear, and there's more of it coming. Trust me. All right. Glad you caught that, Rhino. All right, let me get myself out of here. Let's get to this. Oh, I forgot the disclaimer. Derrick Evans, VA Home Loan Specialist, NMLS 155010. Shoot me a call, a text, or an email if you want to buy or, heck, refi. We can do those too. All right. So this number here, it's not a huge number, but pending home sales get a boost. And notice the negative language here from Diane Olick. Likely due, like in what world do you have to put in the headline the reason for the obvious headline? So the obvious headline here is pending home sales post surprise increase in May. That's really all it should be. They specifically go out of their way here to say it's likely due to the brief. They could have said likely due to pullback in mortgage rates. That also would have been pretty accurate, actually, saying something that makes sense. Likely due to the brief pullback in mortgage rates, which, by the way, we're still in that pullback. That's why I say it's silly to say the word brief. We've got a nice pullback. We have lower rates than what people think. That's one interesting thing about this market right now. Rates are lower than people think. Maybe payments still aren't where they want them to be yet. I just got off the phone I was just speaking with a good friend of mine, has a listing, 92120, great area, $850,000, great price point, detached home, 3-bed, 2-bath. A little dated. The house is kind of a 50s color. He's getting traffic through people are saying they like it. No offers. What's going on there? Buyers are being a little bit more picky because they got to look at the payments. And so what I did was I calculated the payments for him. I showed him okay, here's the payment for a 5% down conventional buyer, $6,100, including PMI. Here's the payment for a VA buyer, 0 down, same credit score at 4.5% instead of 5.99%, $800 a month less. So sometimes you have to look at who is the buyer you're going for, and see if you're on the listing side, or if you're selling your home, like who should we really cater to here? Because either someone with a big down payment's going to buy that house, or you're going to have an FHA or a VA buyer. FHA, VA buyers are getting into houses. I mean, this is great. You want to go out and get into a house this weekend? You can. We haven't been able to say that for years. I like that market. I like it when the market's like that. It just, you shouldn't have to go through all of this to buy a house. You should be able to go shop for homes, write offers, negotiate a little bit, get into a house. And that's kind of back to where we're at. So I like it. Measure of signed contracts on existing homes. Okay, so not new construction. Rose up 0.7% compared with April. So it's just month over month, but it's a nice little bump. And it just shows you there is demand out there, because this is happening in May. So these are contracts in May. So that's with the rate adjustments. Okay, that's full-fledged. There's no, oh, well, those people were locked in at, 3.25. No. Those people are taking higher rates. Now, rates have gone up a little bit since then. Not a ton, but they have. So, not much. So that it's starting to get a little bit more Remember, the normalization process is going to take a second here. Pending sales still over 13% lower than they were year over year, which makes sense. I mean, year over year, my goodness, we're talking about complete apples and oranges here. You can't even talk about it. You can't even compare it, really. But we're going to continue to see sort of ugly year over year numbers for a little while until this gets a little bit better, a little bit more dialed in, and we get that normalization. The normalization process has to sort of come to fruition, and that's going to be a little bit bumpy. It's going to be a little bit choppy. There's going to be opportunities in there. I've already seen multiple people get incredible deals on homes. Heard of a few comp bombs too. We recorded some segments in the studio last week, which we'll be rolling out over the course of the next couple of days here on the channel. So keep your eyes peeled for those. Some really good insights from people who are working, boots on the ground. This is from Keeping Current Matters, and I wanted to bring this up today because, just full disclosure, like I said, always know what the bias is of the media that you're looking at. Keeping Current Matters is mostly for realtors and lenders. It's very, very bullish. Okay, they're looking for the bright spots, but they don't just do it from a conjecture standpoint. It's definitely data oriented, and there's some good data in this. So I don't talk about this a lot. I don't use stuff from the site a lot, but I will here. 2 reasons why today's housing market isn't a bubble. Now, I would agree it's not a bubble, but that doesn't mean that you don't have to have a bubble to have a crash or a significant drawdown in asset values. Okay, you don't have to have a bubble. Bubbles sort of make it inevitable. So I just want to start there with the frank definition of what that means. And I agree, we do not have a bubble. Is the housing market currently in a bubble? They do a little survey here of experts. Who knows if experts know what the hell is going on? Low housing inventory. This is the thing it's a story of inventory. This is the big thing I've been harping on for a long time. The inventory really does drive this market. And this just kind of shows you here in 2007, 2008, 2009, 2010, this is sort of, pre-crash, during the crash, watching the inventory change. Look at the last 4 years. I mean, we just have so many fewer homes for sale. There are just so many less. And is that the way you say that? So much fewer? How do we say that? So there are just a lot less homes for sale. Let's put it that way. Half to 50 to 25% of. So 50 to 75% less homes for sale than we did in that 4-year run. So it's hard to, when you look at the right side of this graph, it's really hard to think that a crash could come from that. It's like I said, if there's going to be a crash in real estate, it's going to have to be several years from now. And maybe this was the beginning, the setup of, it gets a little weird, and then, we're out of the up-only mindset, and then it starts to change, and a few people hang on, and you have to really kind of piece together a bunch of what-ifs, and it would have to be 3 years from now, because we would need to go up-only again for another year or two, and then you could crash. But I don't think you can crash from here. You would need tons of building to go on. You would need tons of inventory. I don't see how it would happen, but a lot of people still think that it's possible, and we're going to continue to monitor it closely. Mortgage lending standards today are nothing like back then, and this is a great illustration. I've been trying to find a graph to illustrate this. This is the volume of loans in billions with a credit score less than 620. Now, back in the boom days, which is all the orange bars there on this chart that's leading up to the crash. Remember, the crash really happened in 2008 and bottomed in early 2009 in stocks, really bottomed in real estate more in 2010, 2011. But, those were the lead up years through 2007. Definitely, I would even go back to 2001, but let's say 2003 to 2007. Look at that. Look at how many loans, people less than 620 credit scores. And then look at since. You can see the Wall Street manipulation. You can see the fraud that took place with the mortgage rating agencies, with the bond rating agencies with regard to these mortgage bonds that were sold all across the world. That right there, those orange bars are what made a few assholes rich and screwed everything up for everyone else.
Check, please.
That's what those are. That's what it looks like on paper. And we don't have that. We don't have that. We have much tighter lending standards. We have much more capable buyers in homes. And right now, unless you've bought a home randomly very, very recently and then a comp bomb just dropped, you've got equity, and you're in decent position there. So it's just not like it was back then in any way. So I would say it's hard to look at this data, any of this data, and say, yeah, we're in a bubble. But you could look at it and say, well, prices have gone up so much so quickly that in itself means that we deserve for prices to go down. And that's not really a reason that prices go down. Prices don't just go down because you're done with it. Prices are too high. They should come down. That's not how it works. The whole aspect of supply and demand has to come into play. And right now, what I think we're seeing right now is really just a rescue operation. All of the people who were FHA or VA buyers who weren't able to get in over the last couple of years, who are now stepping up to the plate and going, it's my turn. They're getting into these homes and they're getting really good terms. We just had an offer accepted. The VA buyer we wrote the offer yesterday, got accepted today. Very small counter for time frames, not price. $12,000 in closing costs for the VA buyer. He's going to get into this thing basically with no money. Pretty much nothing. He's going to pay for an inspection. That might be it. There is opportunity there, and those people who've been on the sidelines or who have been sidelined by the market, they're able to jump in. So we've got a lot of that behind us here, whereas in these days, these orange bar days, that was just wringing the washcloth completely dry. I mean, there was nobody left. If you hadn't bought a home by 2008, what were you doing? You were never going to buy one then. Everybody was buying them. Anyone could get it a loan. I mean, it was just crazy. So that was definitely a bubble. What we have today does not look like a bubble. That does not mean that prices cannot go down. It just means we don't have a bubble, and I agree with that assessment. Let's see what else we got here. Okay, this was like, it made sense to me. It's just what a full circle moment for the city of Kansas City, guys. This is Kansas City, Missouri. I grew up in Missouri, in Columbia, which is right in the middle. My family's in St. Louis. We went to Kansas City a few times. It was hell on earth when I was a kid. Now we're talking 30 plus years ago. It was the epitome of like a big city shithole, like just terrible. A place you didn't want to go. Crime was off the charts. There wasn't anything pretty about it. Went to a couple of games there, Royals games, Royals-Cardinals games, stuff like that. And just thought, man, this place is the dumps. And it really was. All the stats and everything pointed to it. Kansas City got some great leadership like maybe a decade ago. They started turning things around and now is the number one city in the world to travel and work remotely in or work remotely from. Kansas City, guys. And it really is. It is completely transformed, insanely beautiful. They have done all the things that St. Louis should have done. And St. Louis is now the shithole. So, it is what it is, unfortunately. But hey, Kansas City, here I come. And I know a lot of people who are investing in Kansas City, buying multi-units in Kansas City. You can buy duplexes in Kansas City for like $400,000 that have great cap rates. You can buy all kinds of stuff. There's all sorts of opportunities there. All sorts of opportunities there from a real estate perspective. Maybe we'll even talk about that specifically one of these days. Here's one thing I've been paying attention to, or just trying to find information on. It's really hard to find this data. It seems like all of the places collecting this data have some sort of agenda, and I just don't know if you can trust it in a lot of cases. But in this case, 58% of Americans living paycheck to paycheck after inflation spike, including 30% of those earning $250,000 or more. Remember, we leaked that information out a little bit earlier in the month, I believe, as it had showed up on a survey. And, we have to hope that in these boom times that people haven't just gone ahead and just thrown common sense out the window and, hey, we're not managing money anymore. Hey, we're just we're going to live this lifestyle regardless. I have had an uptick in HELOC requests. That's for sure. A lot more people asking about HELOCs. It does make sense, though, if you think about it, because those people would probably just do cash out refis if rates were even remotely close to where their first mortgages are, but they aren't. So they're asking about HELOCs. Yes, we do HELOCs. No, I don't want to do HELOCs. They're a pain. It's like getting a loan from a bank. Everything's manual. You don't have a guideline or a government backdrop for it. So it just kind of what you're on the bank's timeline. It's just like working with Bank of America or something, like to get a loan. I mean, it's not the kind of experience that I want to deliver to people. So that's why I don't like getting people HELOCs, but I can, and I will if you want one. I will help you get one. If that's what's best for you and your family, I'll do it. I just want to pre-warn you that it's going to be like working with the bank, even though you work with me, and I do everything I can to not be the bank. So, but these kinds of things are what I'm looking out for. Like, are we spending properly? Did we save money during this uptick? Are people okay? Do they have reserves? And are they going to make panic decisions to panic sell their homes, to panic sell their cars, to panic sell their big ticket items? It's the panic selling stuff or the necessity selling stuff. Hey, we can't make it right now, so we're going to have to sell one of our cars. That's a necessity sell. Those are the kinds of things that can trigger, crashes in different types of markets. And so I'm just kind of keeping an eye on those types of things. Now, if you're earning $250,000 or more as a couple or as a household, you should be able to figure that out, right? You should be able to figure out how to cut expenses, do something to sort it. I mean, I really, really hope so, because we're counting on you to get your shit together. I mean, bottom line is we're all in this together, whether you like it or not. It doesn't matter if you like it. We are all in this together. It's the whole thing of money. It's all just pieces of paper that we all agree is worth something. I mean, we need everybody in. And so if we're going to be successful as a nation, as an economy, we need everybody to kind of do their part. Now, that doesn't mean everyone should be tight-fisted. That just means that you need to be somewhat responsible, right? Like, I will spend money for sure all the time. I'll spend money on stuff that a lot of people probably wouldn't, or I'll tip someone, or I'll order something, from a local vendor just to say, hey, I'm participating in the economy. I want to help that business out. Hey, those people are here. They're open on this Sunday. I'm going to go buy something from them because I think it's great that they're there. I want to vote for them to exist. But if we have out of control spending, if we're not managing our budgets appropriately, and sorry I keep harping on this, but it's so important, because that is what will cause panic. Oh, wow, all of a sudden we don't have any money in the account and we have bills that are due. What do we do now? Oh, now you're hawking stuff, and that's not good. So we don't want to get there. All right, here's another one. Let's see if we pull this one up. This is what I'm talking about. Housing prices are expected to drop in these cities. Is yours one of them? Huh? And then it just goes on to list these cities. Boise, 73%. Okay, no, wait a minute. So some of the most overvalued cities and regions where home prices could be expected to drop 5 to 10% over the next 12 months include, and this is just from a survey. It's a poll. But look at this. Look at how if someone was reading this, they might go, oh my goodness. Lake Havasu, I just bought a second home there. Flagstaff, Arizona, we have a rental property out there. These are the kinds of things that you're going to start to see more and more of. People predicting specific amounts of, prices dropping, and this market and that market better than that one. We just heard last week that there's a lot of inventory hitting the Phoenix market, like a lot, like way more than we've ever had here. So those things can 100% have impact on overall markets. There's no doubt that the real estate market is interconnected, but only to a certain point. There's some areas that I think have been really overbought, and I think Boise is probably one of them, even though it's a beautiful place. It's probably been overbought. I mean, it's more expensive to live in Boise than it is here. I mean, tell me how that makes sense.
Check, please.
If I owned a home in Boise and the Californians came in and bought the prices up so high, I would just sell my house there and buy one here. Take my equity, go, okay, you guys can have Boise. I'll take San Diego. But there's a lot of second home markets, and we would call like vacation rental markets, second home markets. Big Bear is the most local example, or Palm Springs. Usually you're going to see activity in those markets first if things start to get choppy, because the first thing someone's going to cut is the things that they don't absolutely need. And, a second home or maybe an Airbnb that they just aren't having a lot of luck with or something. Those are the things that you're going to see go first. And we haven't really gotten to that point yet. So like I said, there's a lot of dominoes that still need to fall before you're going to get me to say anything resembles a crash. All right, let's take a look at the chart here for mortgage rates, which are holding on nicely. I did a video for a client earlier. That's why it's all marked up. Anytime we lock someone's rate, I always go through the charts and show them how the rate lock works and all that stuff, just because I think transparency, people should know how this stuff works. So you can see we're still in a downtrend. There's no doubt about it. I think the trajectory is something like this. If you go back, and we've gotten a little bump here recently, last couple of weeks. Hey, a little movement higher. It did come up and touch. I remember I was saying, hey, we'll probably get to here. Just this old support area here will eventually become resistance, and it did. We did touch that, and just kind of cycling now. Looks like we're trying to do the same thing here. Looks like we're trying to, make a case for a run higher in bonds here, and that's why I'm really hoping that this super quiet day today in the markets. I mean, how quiet was this? You guys see it? I didn't even look at the volume. I just looked at the charts, and it was so quiet. Like, man, what is going on here? Usually when that is the case, it means that something is a brewing. And if you let's look at the 1 day here on the Dow, just to kind of see what the market looked like today. Yeah, just very sideways. Not a lot going on. Does that mean that we're poised to go higher? Does that mean that a big drop is coming? I mean, if I look at this chart, this setup here would be bullish. This is where, if you were trading here, you would buy right here. You could set your stop right there, pretty, maybe a little lower, and you have a nice risk reward, because we're going to revisit this number if we go higher, and that's just what it kind of looks like to me. Now, whether we can get through the downtrend, I don't know, but I feel like we might have, 80 to 100 basis points of upside here. So again, this is where strategy really plays in if you are locking loans to, get people locked in right away, but be able to flip the loan to a different bank should something change in the interim, which is something that we can do as a broker. The mortgage bankers, sorry guys, can't do that. Hey, you can float it down, if you get enough of a move.
Yeah.
But, you can't just flip it at will. So I feel like there's some good news potentially coming here, but very well could just happen that it's just a big, ugly red candle that just goes down into the depths of hell. I mean, that also could happen. Who knows? But the way the chart is setting up, it looks bullish. Like I would buy that. If I was trading this, I would buy that for sure. So is that what's going to happen? Are we going to get a nice explosive move higher tomorrow? Is there some good news that's coming that this setup today was meant for? I don't know. But let's keep a close eye on what happens tomorrow. Lock your loans as soon as you get them in. Don't play the game. Okay, lock them in. And let's hope that we get some move to the upside and that you can float down if you're with the banker, or you can just flip if you're with the broker. All right, let's see. Is that it for today? I think that's it, guys. Signing off. All right, if you need help, loan quote, got a loan estimate from another bank, want me to check it out for you, make sure it's legit, interested in HELOCs, cash out refis, purchasing a home, getting pre-approved, shoot me a text, a call, or an email. I'm here for you if you want to buy or refi if you need me. Have a great day, guys, and I'll be in touch soon. Take care.